I want to begin by asking this latest development. Of course, Bank of Japan, I mean, that has ended its negative rate era. It has raised interest rates for the first time in 17 years. I mean, I wanted to understand the possible implications of it on our markets as well as other emerging markets. Because, one thing that comes to my mind, because yen, of course, as we know, is a essential carry currency. So a stronger yen, a higher rate could, impact some FII flows into our markets. But what other impacts do you foresee from this development, sir?
Hi, Suyesh. Morning. Always a pleasure to be on your show. Look, I think it's a massive, massive move by Bank of Japan. To an extent, it was anticipated by the market that Bank of Japan will kind of revert back from the loose monetary policy which it has been following. But ending the negative interest rate regime after such a long is a big signal to the global economy. Honestly, I think, as you rightly said, Japan is the mother country or country of origin from which the carry trade emerges globally. And look, the differential between the US rates and the Japanese rates will still remain fairly large. The Japanese 10-year, if I'm not wrong, should be somewhere in the range of around 0.7 odd percent. And the difference between the US and the Japanese 10-year bond is still fairly high, right? So ideally, the flow of currency or the movement of currency or the movement of carry trade should not possibly reverts by this one rate hike itself, but the signaling to the market is pretty huge out there, right? Japan continues to run an inflation which is over 2%, and which is the comfort zone, as stated, is around 2 odd percent. And Japan is seeing inflation after many, many years. So I think the economy is also pretty hot out there. It kind of reverses the flow to some extent. The amount and the extent of global money which moves out of Japan is a little difficult to estimate right now, and extent to the exposure in Indian markets is also very difficult. It's kind of unknown. Perhaps there's no data around that. But my sense is this will be massive. So even if some bit of that money flows out and moves back to Japan because of higher rates out there, or because the carry trade is kind of not working that well, because look, when you hike interest rates, the currency also appreciates to a certain level. And if the currency appreciates and the interest rate goes up, the differential decreases. I think the carry trade possibly becomes less lucrative. I'm not saying it will completely stop, because the differential, as I said, is still fairly high. But it becomes less and less lucrative, and some bit of flows can move back to Japanese market or Japanese bonds or Japanese equities, perhaps, and can look and can result in some redemptions across the globe. But the extent is fairly difficult to um, kind of imagine right now. But my sense is this will have long-term repercussions on the global markets.
All right, will have long-term repercussions on the global markets. And keeping it with the global markets, I mean, the overall setup is looking, rather bearish. The bond yields are, moving up. The dollar index is moving up. But Brent crude, Mohit, that has, surged by about 5-6%. In the past week or so, in fact, and Brent crude, as we speak, is above $87. That's a 4-month high for Brent crude. And we are approaching that uncomfortable zone. And of course, the crude prices, of course, matters for us, because India is a net importer country. So a lot of segments, and of course it's a key raw material for several industries as well. So the input costs will go up. But are we there in that uncomfortable zone, Mohit, according to you?
Look, Suresh, I think we are already there. To be very honest, there's no point denying that, and there's no point saying that above 90 we will be uncomfortable or not. The crude oil prices have persisted above $80 for a fairly long while. And look, we can always arrive at a number saying 90 is bad, 95 is worse, and so on and so forth, but 87 is no less. Trust you me. And the signals coming from the global economy are not so good, or doesn't augur very well that the crude price is cooling off in a rush, right? Right. So Iraq is talking of reducing the output, and so the signals are not that great. My sense is the globe is just wanting to pass through this month, Suresh. Honestly, I think rate hikes from Japan, US policy meet, where again the market is expecting that Fed somehow gives a signal when the rate cut is likely to happen, which is also not looking very likely or very positive. Then the crude soaring up. So the signals are not very good globally. I think the setup is extremely tight for equities, honestly. And my sense is for next 2 3 weeks this continues to be so, and crude doesn't look like that it is cooling off in a rush.
All right, the markets are of course feeling the heat this morning. We have broken below the key support of 21,900, and all the sectors, they are falling except one. And I'll come to you in just a bit, but I'll get the view from Amit here because he's been tracking the space. Nifty Metal Amit is the only, lone ranger as we'd like to call it here on News 9. It's in the green, everyone else is in red. What's going on?
Lone Ranger still in the green, though it has been correcting from yesterday today. But after you talking about repercussions on local markets from global cues, China's industrial data pointed towards a 7% growth in the January-February quarter of financial year 2024. Nifty metal rose almost 2.5%. The biggest gainer was Tata Steel that jumped almost 5%. Little correction today. The steel industry now expects restrictions on imports. We are a net importer of imports. But metals as such, if you look at the stocks across, they were floundering in the negative, be it last 5 days or last 1 month. They were almost all in the positive. SAIL was up, NMDC was up, Hindalco was up, Nalco was up, so was Hindustan Copper, Welspun, Ratnamani. All of them were up yesterday. They gained because of this news. Mohit, we are a net importer of steel. So if the Chinese industry is doing well, should we not be worried, or is there some sort of Ricardian economics playing here?
Look, Amit, I think that's a very interesting point you mentioned. We ought to be worrying, to be very honest. I think if the Chinese economy or the output is growing, honestly, India continues to import steel, and China is the biggest market from which we have imported steel for last 10, 11 months data. Also, if you look at it, I think the net import from China is massive. So we continue to run the thread that China will pump in a huge amount of steel into Indian economy, which is a guzzler of these metals. Honestly, given the construction activity and given the rapid economic development which is taking shape. So my sense is, I think market is anticipating some kind of steel cuts. Sorry, some kind of duty restrictions out there. I'm not sure whether it can come immediately or will come post elections, or how will that take shape. But I think the industry is expecting some kind of restrictions out there, which should kind of give a support level to the metal stocks out here. Perhaps I think sometimes the metal stocks also play up a rally in terms of the inventories which they run. If the inventories are significant and the prices have gone up, I think that also kind of plays up on the stocks. But my sense is this is one space which ought to be watched very closely, especially the steel part.
uh, uh, Especially steel, of course. Mohit, there's another industry that we have been talking about, and that is the electrical vehicle space. And with the new EV policy that the government has come up, a segment in the market of auto ancillaries is likely to benefit. But CIA, Automotive, Varroc, all of them jumped yesterday. But for Sona, BLC, Precision and Matherson, which are likely to benefit from Tesla coming in, those stocks did not react in the positive. What is your take in the matter in this space?
Look, I think there is no two doubts about it that the policy revamp is a very, very fine balancing act which the government has done, right? And it is more to accommodate Tesla in the Indian markets. However, I think the 3 year and the 5 year clause on localization is something which is pumping up the auto ancillary stocks in the market. Look, I'm not pretty sure as to who will be the ultimate beneficiary out here. The verdict is still out, still yet to be decided. Honestly, 30% in next 3 years and then 50% in 5 years leaves a lot of space for the companies to decide as to what component they really want to pick up in India. Though I understand that Motherson Sumi and Sona BLW are at the forefront of technological things which perhaps EVs in India are using and can be compatible with Tesla also. But you never know. Look for Tesla, perhaps those. guided dashboards and those automatic what do you say, the components perhaps might be too critical for the vehicle, and they might just want to import it for some time before they can actually start some local manufacturing of it, or they can pass on to the local manufacturers in India. So it's too early to call it out whether they will be like real beneficiaries. Having said which, I still continue to assume that these two companies should benefit a lot. But again, as I said, it's too wide open right now, and I would still wait for some more clarity before we can exactly pinpoint that yes, these are the two players who will benefit the most. To my sense, I think it's still not so clear.
All right, that's the view on auto ancillaries. But Mohit, before we let you go, I know you don't like to predict short-term moves, but 21,900 has been a key support for Nifty in the short term. I mean, the last 4-5 sessions we have seen a bounce back from that, but this morning we have broken below it. Could that probably kickstart the next leg of downside from here on? And if that's the case, how much do you think we fall?
Look, Suresh, domestically, I don't see any big triggers which can actually lift the market. And globally, as we spoke in this show itself, that the setup is not looking very comfortable when it comes to crude, when it comes to the policy rates across the globe. So I think it isn't very comfortable scenario right now. Plus, obviously, there is this chatter of market heating up, the regulatory glare on the small and mid caps. As I interact with a lot of small and mid cap fund managers, because that disclosure is now fortnightly or every month, there is a chatter in the circle that they will have to kind of compromise some bit on the portfolios, right? So they will have to kind of liquidate few positions and mobilize some cash and or move a little towards more large cap kind of holdings or something like that. So and if that were to happen, you can continue to see some selling on the mid and small cap space for another 15 days or maybe a month or so. So my sense is for next 15 days to a month, I think we are in a wait and watch kind of a scenario. Perhaps we might not value correct so much, but yeah, I think we might just spend time around these levels a little bit more than what we anticipate.